Joining me now is Michael Reinking. He's Senior Market Strategist for the New York Stock Exchange. Michael, it's great to have you, especially after major moments like these.
Yes, it's good to be with you. It's been like drinking through a fire hose this morning in terms of economic data, central bank rate decisions, and just the amount of earnings that are flowing in.
Yes, indeed. So let's start actually with some of the economic data. We'll get to the Fed decision, of course, yesterday, but GDP coming in 2.3%. What does that mean?
Yeah, so a little bit below expectations, but still a very solid number. It is showing some moderation from the previous quarter, right? And we also saw the prices component come in, a little bit below expectations, but that did tick up from the previous quarter. The backdrop remains very solid, but the consumer spending number was also very strong. It was up 4.2% from 3.7% in Q3, right? So that continues to, kind of the overarching economic backdrop, kind of solid but moderating.
And how does the Fed decision factor into this, specifically what we heard from the Fed chair yesterday?
Yes. So yesterday's meeting was widely as expected, right? The Federal Reserve left rates unchanged, for the first time in 3 meetings, right? So we just came off of, 3 consecutive cuts of 100 basis points in total. Chair Powell had suggested during the December meeting that we would be on hold, right? And he reiterated that yesterday. I'd say much of his messaging was in line with what we previously heard. He continues to show that he has a bias for further easing, but in order for that to happen, we're going to need to see the inflation data start to cooperate, or on the negative side, you would need to see kind of a real weakening in the labor market, which nobody's really rooting for at this point.
It is interesting, though, because the last inflation read that we had, both for consumer and producer prices, they were pretty much in line with expectations, not above or a surprise for that matter.
Right, yeah, and you're exactly right. And I think what the Federal Reserve is telling you is that they are confident in where kind of their policy rates currently are. And he said it multiple times, we're in no hurry. He suggested they're in kind of a wait and see mode, waiting to see what Washington policy looks like, how that's going to impact the economic backdrop, right? And in order for them to really feel like they need to move further, they need to see some further progress, kind of in the inflation data.
So to that end, we will get another inflation read on Friday, tomorrow, and that is the Fed's preferred inflation gauge. Is there anything in particular that our viewers should be watching for in that report?
So I think, given the fact that we've already seen CPI and PPI that do feed into PCE, markets are a little bit desensitized because you can kind of back into what those numbers look like. So there shouldn't be any real major surprises, right? There is an expectation that we could see the number come in slightly below expectations, but I think just from what we've heard from Chair Powell, right, I don't think that number is going to really move the needle.
Corporate earnings also a factor, moving markets, mega cap technology names, the most richly valued companies out there, of course, reporting last night. We'll get Apple after the close tonight. What are the takeaways from these results so far?
Yeah, so I mean, the world got turned upside down coming out of kind of last week's kind of DeepSeek announcement that created a lot of volatility kind of heading into the kind of the tech earnings that we heard last night. In terms of the messaging from kind of the major CEOs, it was very similar to what we've heard. Doesn't sound like anybody is changing their any of their capex plans, right? We just heard last week the Stargate announcement. Meta did update their capex spending numbers, kind of just last week, so you wouldn't expect to hear anything kind of yesterday. They're still very positive in terms of kind of the AI backdrop, right? And they've talked about the idea that if you start to see further efficiency and kind of within these kind of AI models, right, that's just going to drive further adoption, and it's kind of generally a positive thing.
How does the market look to you at these levels?
So we've really been in this kind of trading range, like really since the election, right? So interestingly, I kind of noted this morning that despite all of this volatility that we're seeing, right, that yesterday the S&P 500 closed 10 points lower than where we were right before the previous Fed meeting, which did kick off a bout of volatility, right? So we're in this 300-point range in the S&P 500, 5,800 to 6,100. We're kind of in the upper third of that, currently, and it does seem like we're in this consolidation phase, waiting for some more certainty. I think, kind of coming out of Washington, coming out of the policy, and I think the earnings backdrop, kind of going back to that, as you just pointed out, I think what we're seeing this quarter is the numbers are solid. Some of the guidance is a little bit weak especially kind of looking in kind of the industrial space. But what that does, something that we had pointed out in our earnings preview, is that what that does is potentially you're going to set markets up, for kind of a positive earnings revision cycle as we move through the back half of the year.
Interesting. I do want to ask you, Michael, of course, about the news earlier this week in regards to DeepSeek. We had seen a knee-jerk reaction. Some of that seems to be smoothed through a little bit. Markets seemingly a little bit more stable these past few days, but what's the best way to interpret that?
Yeah, so I mean, there's still a lot of skepticism, right, and kind of around kind of what came out of the DeepSeek kind of model and what kind of the inputs were and how they kind of drove those gains. What it did is really, from a market perspective, highlight just how much concentration risk and kind of a crowded positioning that we're seeing in kind of a lot in this like AI theme, right? And so it's just caused a little bit of a rethink, right? And markets, traders, and kind of the industry as a whole, right, are trying to understand kind of what is happening here, right? And it's going to take a little bit of time for that to kind of play out. I don't think it necessarily kind of turns kind of this kind of turns things on upside down, right? But it is kind of just putting a little bit more of kind of a microscope on some of this CapEx spending that we've been seeing, and just kind of companies are going to kind of need to continue to just talk about what that spending, how that spending is going to ultimately kind of drive the business going forward.
Michael Reinking, Senior Market Strategist for the New York Stock Exchange. Michael's going to rejoin us, of course, just after the market open. Thank you.
Perfect.
Well, rejoining me now, as promised, is Michael Reinking, Senior Market Strategist at the NYSE. Michael, now that we are officially open for trade,
yes,
what do these levels tell you?
Yeah, so we're recouping yesterday's losses is pretty much where kind of the S&P looked like it was opening up. Again, we as we talked about in the last segment, right? We're in the kind of upper third of this range, right? And it continues to seem like we're in this consolidation phase.
Certainly a consolidation phase, and believe it or not, January will come to a close tomorrow. We've really covered a lot in just a short amount of time, kicking off 2025. There are some seasonal trends that historically Wall Street will follow. How have those played out this year? Yeah,
so specifically there's this January trifecta, which is followed by the Stock Traders Almanac. Right, that starts with the Santa Claus rally, which is the final 5 trading days of a calendar year and the first full 2 trading days of the new year. This year that ended up in the negative territory. Then there's the 5 full trading days. That was also in negative territory this year. And then the final of those is the January effect and how the final month of, or the first month of the year it closes. At this point, we're solidly higher for the month of January. So barring a very significant sell-off in the final 2 days, it looks like we're going to end higher. Now, typically, what kind of traders will look at those kind of the performance over those time periods as an indicator as to what the kind of the rest of the year's trading looks like. So going back, there have been 7 instances where the Santa Claus rally failed to come to broad and wall, right?
As they say.
There have been 7 instances in the past where January has ended the month higher, right? And the market's ended higher 6 of those 7 years, right? And with very, very solid returns. Last year being one of them. Last year, we also had both the Santa Claus rally and the first 5 days were down. We ended up, kind of over 20% for the year, right? So, things, kind of with how January has played out, right? Things still look, kind of pretty well set up going into the next year.
It's been a while since we've spoken, Michael. I think probably the last Fed decision, actually, at the end of 2024 in December was the last time we're together. So, of course, digesting everything that's happened in the past 24 hours, the month of January, these seasonals. What is your outlook, big picture for the year?
Yeah. So. The other seasonal that I'll just highlight is as we're heading into February, right, during election year or the year after elections, right, that Q1 time period tends to be the worst quarter of the year, right? February average returns, post 1970 are down a little over 1% in the February timeframe. So just to be aware, kind of, seasonally, that we're in a little bit of a difficult time period, and that sort of makes sense when you think about kind of where you are, because you have the inauguration, you start to have some uncertainty, kind of seep into markets as you start to see some of the new Washington policies, kind of come into place. My big, kind of one of my biggest takeaways, kind of heading into the year was that there was this expectation for volatility, right, to pick up, and we've definitely kind of seen some of that. Kind of at the end of last year and as we've started this year. And I think there are a couple of different things that are going to drive that volatility. Washington policy being one of them. You're kind of continuing to pay attention to how the interest rate environment evolves and potential volatility around treasuries. Kind of crowded positioning. We just got a little whiff of that over the last week. Right, and then the expectation that at some juncture this year we'll have an inflation scare. There may be a growth scare. We might have actually just come off of our first inflation scare, with CPI kind of seeming to calm markets. But overall, right, I do think so. While we have volatility, that doesn't necessarily mean, right, that markets can't perform well, right? And I'm still, kind of pretty positive. I think we have a solid economic backdrop.
Yes.
Which we highlighted in kind of that first, in our first segment. We have a Federal Reserve that still seems to have a bias to want to ease policy rates. And we also have an earnings backdrop, which looks like it can accelerate.
All right, Michael Reinking, Senior Market Strategist here at the NYSE. Michael, thank you as always.
All right, thanks for having me.